Good morning. I'm sure you've seen the numbers. Have you? Your initial thoughts, ma'am?
Well, I think we're seeing both CPI and PPI rising a little bit compared to our forecasts. But I'll just start with CPI. Headline CPI stays relatively still subdued. I think that's because core inflation might be still showing weaker domestic demand, while on the other hand, we're seeing higher energy commodities as well as in China's case vegetable prices to be putting some upside pressure to CPI. But overall, CPI remains well below the government's 3% target. Shouldn't be any concern for the PBOC's easing plans. As for the PPI, we think that the energy prices and commodity prices are rising, which is putting more pressure on PPI and which might be delaying the PPI's normalization path later this year.
Okay, and if you could just outline for that then, what do you think are the trends to follow as far as inflation is concerned on both CPI and PPI?
Well, I think for CPI, I think since we're in the pork prices are still in a deflation cycle, so overall we're going to see a relatively gradual increase in terms of PPI. Our annual forecast for PPI currently sits around 2.1%, which is well below the 3%. For PPI, we should be seeing some normalization trend this year after the high base we have observed last year based on higher commodities and energy prices. But the current rise in energy and commodity prices making the normalization path a little bit more complicated than our previous expectations. So we think that PPI might be staying at this current elevated level for just a little bit longer than our previous forecasts.
And your current assessment of the economy right now, given some lockdowns in many big cities?
Yeah, I think the lockdowns currently, because of this COVID outbreak, is definitely adding more pressure to China's growth, both in terms of supply as well as demand. On the supply side, definitely we're going to see more disruptions to global supply chain, and that might be rippling through the global picture in the coming months. And on the demand side, as again, the past few COVID lockdowns has shown us that services, consumption sector are harder hit. So just based on this lockdown, which is seems to be wider in scale as well as extending in Shanghai, I have downgraded my GDP forecast considerably to 4.7% to reflect the disruption and its impact in the first and second quarter of this year.
Okay, and just to clarify, 4.7% for the first quarter, is that a full year projection?
4.7% is a full year projection for this year's GDP, which sits below the 5.5% target from National People's Congress, which we think that because of this COVID lockdown and these implications, it might be putting more pressure on China's growth this year.
Now, in terms of the policy offset and response, do you think then, given what you've outlined, that the policy response needs to be much bigger now than our expectation just a month back?
Well, I think both the policy easing needs to be front-loaded, which means there are more urgency for rolling out easing measures, as well as a relatively stronger policy response, which is in particular needed for SMEs and corporate sectors. So for the front-loading part, we are forecasting a 10 basis points rate cuts in April or a 50 basis point triple R cut to stabilize credit expansion. And for the moderately stronger easing policy package, we think that there's room for fiscal easing to be stronger in response to what happened in the economy right now. So we think that local government might accelerate its infrastructure plans, as well as there will be more tax cuts extended to corporates.
Now let's talk about the currency. I'll go as far as saying it looks strong. Do you think it's too strong given the fundamentals?
Well, I think just as a broad view, we are relatively more neutral on CFAX index and renminbi, but it doesn't mean that there is a much more weakening pressure because the outlook is more balanced. On one hand, we're seeing more lockdowns, which means that tourism outflows resumption might be delayed, which is still going to support the currency to some extent. But on the other hand, we're seeing a weakening growth momentum, a narrowing US-China yield differentials as the market expects more PBOC easing, easing and more Fed hawkishness in coming quarters. So that's definitely going to put some upward pressure on dollar CNY. And overall, we think that renminbi is just going to remain relatively stable. And we're still looking for a mild depreciation against the US dollar and a more neutral outlook for CFAX index.
Understood. Okay, just give us a preview then. We have monthly activity numbers coming in the next few days, maybe some credit data. You also have first quarter GDP. Just your broad expectations of those numbers.
Well, I think broadly, we're probably going to see Q1 GDP slowing just because of more lockdowns. And more in details, I think retail sales might fall into a nominal year-on-year contraction, while industrial production, the disruption is milder to the production sector because of the closed-loop management. So we're seeing around 1 to 3% kind of growth for industrial sector. Trade surplus is going to remain relatively robust, but we might be seeing a moderating trade surplus in coming months. And credit impulse, I think it's just going to pick up, but we're going to focus much more on the loan demand. So if loan demand remains weak, we think there's higher chance for rate cuts coming through.